Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about President Trump's remarks on home prices and what happened to the 10-year yield after Kevin Warsh was named the next Fed chair. First, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
You know, after every week, every Friday this year, I always say, what a week. And then last week I said, what a week. I say this every week of the year. And, you know, we went into this with X variables and all these things and it hasn't disappointed.
It is not disappointed. So, of course, last Thursday, Trump said, hey, I am going to announce the new next Fed chair. And then on Friday morning, which we're doing this on Friday afternoon, he announced Kevin Warsh. So we did a special episode on that. And we'll get to some more Kevin Warsh things. But first, I wanted to talk about some remarks that President Trump made on Thursday, where he was talking about home prices. And I think he's trying to thread the needle there of like, you know, how do you make things more affordable without crashing home values, right? So he was talking about home prices and he said, we want to keep home prices high for people who are already own homes. And, you know, it was kind of a confusing message, but I do think that the nuance for people in housing is that like affordability is a two-edged sword in some ways, right? If you bring down the equity people have in the homes, that's not the best maybe way to do affordability. What did you take away from his remarks?
I've always hated this entire conversation. This whole thing about presidents and people saying, well, we want to drive home prices down, X and these things, supply and demand equilibrium from housing, from those that read. You know, it's funny because, you know, when President Trump made that and the video went out, I said, here's the history of home prices going back to 1942. Think about how many recessions, how many crises, you know, mortgage rates up to 18%, mortgage rates down to 3.25%, all these things. And the only thing that drove national nominal home prices to fall was a completely deterioration of the housing credit market, where you had foreclosures, underwater homes, very high levels of inventory, distressed sales as a higher percentage. I know a lot of people say this, well, we have to drive home prices down by X or Y. The market doesn't give a bleep what the president says or some jackass on YouTube or some idiot on Twitter or some whatever it is. Okay, all the market is playing off of the supply and demand equilibriums. And how do we know this? Is that this has been tested now. 100 years will go by. And what occurred is the marketplace from 2005 to 2008, where home sales peaked, crashed all the way down to 2008, had a vertical inventory scale with major distressed inventory about to come online. The last 3 years of 2023, 2024, and 2025 had home sales crash, stay very low levels, except the inventory data looks different. Homeowners do not have to do with whatever a sitting president says. And again, some person on YouTube or anything is basically working off the supply and demand equilibriums. And we just go off what the economy does with the data. So I've always hated this, like there's some lever to push. Or we are, after 3 years of the lowest home sales aren't falling anymore. So we need to crash it more. Something needs to happen. No, the Federal Reserve itself doesn't make policy around the existing home sales market. That's not part of their dual mandate. So it's such a useless conversation. What happens is the history of housing economics has showed us there's been plenty of times. You know, 1946, 1947, home prices are up 24 and 21%. Did they go, oh my God, we need to, you know, stop BlackRock from buying all the homes or mortgage-backed security purchases of the Fed? No. We've had these episodes before. What traditionally happens, inventory rises, price growth cools down. There's parts of the countries where home prices fall, and there's parts that are still rising. But if housing was so unaffordable that nobody could buy, think about the logic. If you were past a second grade education, you could understand this. Home sales would be crashing. And then supply would be rising, days on markets would grow, prices would have to be cut to move product. That's not happening because the people that are buying and selling homes right now are doing it at a certain level. And now as rates fell a little bit, price growth has cooled down a little bit, wages are still rising faster. Naturally, affordability got a little bit better. So this is why the housing demand data has picked up recently. If housing demand data picking up with mortgage rates not even below 5 or 6% is telling you that you don't have a massive affordability issue with the people here. So if you're trying to say, well, we can create more buyers if somehow something miracle happens that has not occurred outside of the one period of time where you had distressed sales. And that's why I've always thought it was a useless conversation. It's for, rookie people running around there. That's not how economics works with housing. You have to deal with the realities of what we have here. That was the whole point of the unhealthy housing market savagery, is that I knew eventually, once rates rise, this is what's going to happen. And it takes time, right? Time. People have to endure, and then the market works itself out, which has, so that's why I like to talk about the 1980s when affordability was worse. And people said, nobody's going to buy homes ever again. Everyone's going to be a renter. And rates fell, price growth scrolled down. There you go.
Interesting. Well, what we see is that there's, frustration at the federal level that they can't do more to stimulate housing or to make the housing financing better or whatever. And so we've seen over the last two administrations, right? We saw when Biden was in and was talking about incentivizing borrowers with a $25,000 down payment, right, in cash. We've seen the Trump president, the Trump administration try all sorts of things. The 401k, maybe that's going to be the down payment, or 50-year mortgage. I think in all cases, it's like, how do we expand home ownership for people who right now can't afford it? And I think your take is like, if you can't afford it, don't do it.
You just endure. If it was me, I'm not doing anything.
Right, I know.
That's just, I let the marketplace kind of work itself out. But obviously, when you have the third calendar year of the lowest home sales in 2025, and then the fourth year, but again, demand curve is picking up, right? There's no law that says existing home sales have to be at X amount every single year. These things occur throughout history, and over time, they work themselves out. So, of course, my answer, I know, is not politically, acceptable, but enduring would be the way I go. But there is no magic button where people say, well, home prices have to fall to X. And, home sellers have to be, no, home sellers are just basically working off the supply and demand equilibrium like they've had for decades and decades and decades. And what's happened is rates is falling a little bit lower, and demand has picked up, which kills a lot of narratives that affordability is terrible and nobody could buy a house. And then all of a sudden, when did the market change, Sarah Wheeler?
Mid-June.
Mid-June. What happened from then? That was the bottom of home sales. The growth rate of inventory slowed. Home sales rise. Supply and demand equal. That's mother marketplace working. Why, Sarah Wheeler? What is the mother marketplace? Oh, I know you don't want to answer this, but she is a serial killer.
She's not a serial killer.
She has left so many clues since mid-June. And she said, homies, Logan Mohtashami was right all along. The growth rate of inventory is slowing. Rates get below 6.64. Housing demand picks up. And, this is just how economics work. Now, this isn't the sexiest answer or the most fun or the most doom porch, but this is how economics have worked since the Peloponnesian War. Wheeler.
All the way back there. Okay, so did not mean to trigger you with that question, but I was going to ask you anyway, even if it does trigger you.
Oh, that triggers me. Don't try to say I'm not triggering. Whenever everyone listen to this, when Sarah says I didn't mean to trigger you, she's like, I'm going to trigger Logan. I know
it's like, well, I have to ask you this question, even though I know you're going to be
Sarah,
like,
you should ask me. Should I buy a house?
No, I'm not. We're not having that discussion. No way. Okay, we have to talk about what happened after the announcement of Kevin Warsh. What are we seeing on the 10-year yield? What do you think is going to happen with mortgage rates?
So, it's funny. Thursday, I did this John Hamm meme. It's with me dancing, in
the club, right?
And I say, look what the 10-year yield is doing in mortgage rates. Not much is happening. Even with the Warsh, the 10-year yield that went up initially, it came back down. It's just hovering around 4.25 last time I saw. So again, I believed in this principle for some time, and I've talked about it here on this show for a long time. 65 to 75% of where the 10-year yield can range in within a cycle, going back to decades. Why do we do the slow dance, Sarah Wheeler?
Right.
We teach people the slow dance is because a lot of people were told that this will push rates up higher or this will push rates lower. Fed policy really drives it. And then the spreads got better. So with the spreads better, volatility is somewhat compressed. And we've had, this is like Jack Bauer 24 on steroids. We had Greenland, we had Japan, we had Davos, we had a new Fed chair. We have all these things. The volatility isn't as much because policy is less restrictive now. So I know a lot of people say, well, the 10-year yield, the bond market vigilantes will push, Fed independence. We are not Argentina. We are not Turkey. We're not the euro. We're not Japan. I'm sorry to the New World Order doomers out there that are like, oh my God, the dollar's about to collapse and nobody's going to hold it. This is the United States of America, people. We are the biggest, wealthiest economy in the history of the world. We have the biggest military, right? Nobody pushes us around. Trust me. So the bond market treat us as such. So I think it's some realistic that, hypothetically, let's just say the 10-year yield does go to 440, 450, and the economic data was getting worse, right? That would be something that, but we're talking about 440 to 450. We're not talking 6, 7, 8%, or the bond market has just lost faith in the US dollar and all these crazy talk. So not much is happening. It's so confusing because, when Trump talked about, he said, I'm probably not going to talk. It's inappropriate to talk about rate cuts with Warsh. And like 6 minutes later, I've talked about rate cuts with Warsh. I'm telling people, man, you kind of have to somewhat ignore a lot of these headlines and just follow the data. And what has it shown? The slow dance has worked again, right? It isn't so much about mortgage-backed securities. Mortgage-backed securities, the purchase or whatever it was, I thought was a defensive move. Look what's happening. We're just basically still in the range, and Fed policy is less restrictive now than it was in 2023. And we'll work off the economic data. I thought one of the more notable things that happened Friday morning is Christopher Waller basically came out and said, listen, all I'm doing is channel checks kind of, and it looks like we're going to have planned layoffs in 2026. And when they revise the numbers in 2025, there's no job growth whatsoever. So the labor data is still softer, and that's what really drove rates lower. And until that changes, right, that to me is a more valid premise. If all of a sudden the labor market starts accelerating higher and the unemployment rate falls down and inflation is above target, and then wage growth, which was decelerating, goes up. Those things are a more valid case for rates to go up. Nothing spectacularly big, but higher within the range. So that's kind of what drives the show. And I'm not a fan of Kevin Warsh. I've never been a fan. I just don't think he understands how a lot of things in monetary policy or cycles work. He's got some confusing thoughts with the balance sheets and stuff. But in this case, this is Kevin Warsh 2.0. This is not the Kevin Warsh of the past. There's no way that guy would ever even be allowed in the White House. Okay, his family and Trump's family have been friends for a long time. So we'll take it from there. But again, to me, the economic data matters because hypothetically speaking, if jobless claims had broken out, if the economy was really breaking, rates can go lower because the bond market is pricing below neutral policy. We're all fighting here for what neutral policy looks like. That to me matters more than this. But I mean, it's just, there's no way Kevin Warsh would have been allowed in the White House if it was old Kevin Warsh, right? But for this thing, it's just, we got to take it as 2.0 and go with it.
And I think this is the good news for people in our industry. Like, volatility is not good for business, generally speaking. So it's great to see that things have stabilized. And even with some of the crazy things that have been headlines over the last couple of weeks, not to say even months, that we're still kind of where we thought we were. And that
little John Hamm dance,
the dance
and that's why I've always said the spreads can compress things and create more calmness. And that's the history of economic cycles. And this is why so much, by the way, if my father is listening, which I know he isn't, this is why mortgage spreads getting better is a good thing. Homie, you're not my dad. Seriously. But I think that's one of the things we've tried to teach, and it's a positive. We've got that.
It is a positive, and we will go with that. And actually, for me, we've been talking on this podcast. We're like, who knows what will happen between now and the next one, which is always still true. But at least now we know the name of the next Fed chair, barring something crazy happening. And so I think that's great. We're like, okay, that's done. And to me, the good news is like there is some stability despite a choice that many people were surprised about.
Yes, it is. Stability is a good thing.
All right, we'll go with that. All right, Logan, thank you so much.
Pleasure.